Have you ever wondered how inflation affects your money? It's a question that many of us may not ponder on a daily basis, yet it holds considerable weight in our financial lives. Inflation, in its simplest form, is the rate at which the general level of prices for goods and services is rising. Imagine your favorite chocolate bar. Now, imagine that chocolate bar shrinking bit by bit year after year. That's what inflation does to your money. It erodes the purchasing power of your hard-earned dollars, making them less valuable over time. This is why understanding inflation is so crucial. It's not just about economic theories or financial jargon, it's about your everyday life, your ability to meet your needs and fulfill your desires. So, are you intrigued? Are you eager to understand how this invisible force is shaping your financial future? So, ready to dive into the world of inflation and find out? Stay tuned. Inflation, in simple terms, is the rate at which the general level of prices for goods and services is rising. Now, let's break that down a bit. Imagine you're at your favorite bakery, and your favorite loaf of bread costs $2 today. But if the rate of inflation is 2% per year, that same loaf of bread will cost $2.04 next year. That's inflation at work, subtly but surely increasing the cost of goods and services over time. But where does inflation come from? Well, there are a few different causes. One is demand-pull inflation, which happens when demand for goods and services outpaces supply. Think of it like an auction. If there are 10 bidders for a single painting, the price is likely to go up, right? The same principle applies to the economy as a whole. Another cause is cost-push inflation. This happens when the cost of raw materials or wages increases, forcing companies to pass those costs on to consumers in the form of higher prices. For instance, if the price of wheat rises, your favorite bakery might have to charge more for that loaf of bread. Inflation also has broad impacts on the economy. It erodes the purchasing power of money, meaning your dollars don't go as far as they used to. It can also create uncertainty, making it harder for businesses to plan for the future and potentially slowing down economic growth. However, a moderate amount of inflation is generally considered healthy for an economy. It encourages spending and investment, as people are incentivized to use their money now, rather than hold on to it and watch its value decrease over time. So, while inflation might seem like a complex concept, it's something that affects all of us in our everyday lives. Whether we're buying a loaf of bread, planning a vacation, or saving for retirement, inflation is a constant companion, continually shaping our financial decisions. Inflation is like a slow leak in your wallet, gradually diminishing your buying power. So, you might be wondering, how does inflation affect my money? Well, let's dive right into it. Think of inflation as a sneaky thief, slowly but surely chipping away at the purchasing power of your money. Imagine having $100 in your pocket today. Thanks to inflation, that same $100 will be worth less next year and even less the year after that. Here's how it happens. As the general price of goods and services increases, each unit of currency buys fewer goods and services. This is a result of inflation. It's like being on a treadmill, where the speed gradually increases. If you don't pick up your pace, you'll fall behind. In terms of your money, if the return on your investments doesn't keep up with inflation, the real value or the purchasing power of your money falls behind. Now, consider this. If inflation is high, the cost of living goes up. You might notice that your favorite coffee costs a few cents more, or your monthly rent increases. That's inflation in action. It's not just about numbers on a page, it's about how much you can get for your money, and that directly impacts your lifestyle. It's important to remember that inflation doesn't just affect consumers, it also affects savings. If you've stashed away some money for a rainy day or for your retirement, inflation can erode the value of those savings. Let's say you've saved $10,000. With an inflation rate of 2% per year, in 10 years, you would need roughly $12,000 to have the same purchasing power. That's $2,000 of your savings eaten away by inflation. So, whether it's the money in your wallet, the money you're earning, or the money you're saving, inflation impacts it all. It's an economic reality that we all have to come to terms with. In essence, the more inflation we have, the less your money can buy. Now that we understand how inflation can eat away at your money, what can we do about it? Well, one of the best ways to protect your money from inflation is by investing it in assets that tend to increase in value over time. These are often referred to as inflation hedges. Real estate, for example, has historically been a strong hedge against inflation. As the cost of living rises, so too does the value of property. By investing in real estate, you're essentially locking in today's prices for a commodity that's likely to cost more in the future. Stocks can also serve as an effective hedge against inflation. Companies can often raise their prices to keep pace with inflation, which in turn can lead to increased profits and higher stock prices. Of course, investing in stocks isn't without risks, but over the long term they have proven to be a powerful tool for wealth creation. Gold is another asset that people often turn to when inflation is high. Because there's a limited amount of gold in the world, its value tends to rise as the value of money decreases. It's a bit like a financial lifeboat, helping to preserve your wealth in turbulent economic times. Now, while investing in assets like real estate, stocks, and gold can help protect your money from inflation, it's also important to diversify your investments. Putting all your eggs in one basket, so to speak, can leave you vulnerable if that particular asset class takes a hit. By spreading your money across a variety of assets, you can reduce your risk and potentially achieve a more consistent return over time. Another strategy for protecting your money from inflation is to plan for it in your retirement savings. If you're saving for retirement, it's crucial to factor in the impact of inflation. If you assume a 3% rate of inflation and you're 20 years from retirement, the cost of living will be nearly 60% higher by the time you retire. To keep up, your savings need to grow at least as fast as inflation. That's why it's important to invest your retirement savings in a mix of assets that are likely to grow over time, rather than just keeping it all in a low-interest savings account. It's also worth considering inflation-protected securities, such as Treasury Inflation-Protected Securities, TIPS, in the United States. These are government bonds that adjust in value with inflation, ensuring that your investment keeps pace with the rising cost of living. Finally, remember that inflation isn't always a bad thing. Moderate inflation is a sign of a healthy, growing economy. It's when inflation gets too high or too low that problems can arise. Remember, the goal is not to eliminate inflation, but to manage its impact on your money. It's about being proactive, staying informed, and making smart decisions with your money. That's how you can protect your wealth from the eroding effects of inflation. So, let's quickly recap what we've learned today. We started off by understanding what inflation actually is. It's the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Over time, as the cost of goods and services increase, each unit of currency buys fewer goods and services. This is the economic reality we all grapple with. We then dived into how inflation affects your money. It's like a silent thief, slowly but surely eroding the purchasing power of your hard-earned cash. If you're saving money under your mattress, or even in a low-interest bank account, inflation is quietly eating away at the value of those savings. It's a relentless force that never sleeps, making your money worth less as time goes on. But it's not all doom and gloom. We also explored some practical strategies to protect your money from the effects of inflation. Investing in assets that tend to increase in value over time, such as stocks, real estate, or even certain types of bonds, can help to preserve or even grow the purchasing power of your money. Diversifying your investment portfolio and keeping a keen eye on interest rates can also be effective strategies. Remember, the key is to be proactive, not reactive. Don't wait for inflation to start taking a bite out of your money before you take action. Start implementing these strategies today to ensure your money continues to work for you, not against you. We also discussed the importance of financial education. Understanding how the economy works, including the role of inflation, is key to making informed decisions about your money. So keep learning, keep asking questions, and keep engaging with financial topics. Inflation might seem intimidating, but with the right strategies, you can keep your money safe. Thanks for watching, and until next time, keep an eye on your money.